Hi, everyone. Welcome to another episode of Tax Talk Unfiltered. This is season 2, episode 3, if you can believe it. And I am joined by a familiar face and then a new face, which is exciting. So I've got Julie Suskin, head of tax, with us again today. And then we've got Adam Bolitho. I hope I pronounced that right, Adam. If it's wrong, you can correct.
Bolitho, yeah, but yeah,
Okay.
close enough.
Okay, great. And Adam is a new tax manager at Gelt, so we're excited to have him, and we're throwing him into the content creation storm right away. So thanks for being willing to do it, Adam. And today we are talking about the tax day countdown. So March 15th, April 15th, focus mostly on business owners, but we'll talk about some personal tax items as well, I'm sure. And we're thinking about what do you need to do as the clock is ticking and we're getting closer to tax day. So the goal of this conversation, we want to help you understand some last minute mistakes that we want you to avoid, smart decisions that you could consider as we get closer to the deadline, and then just overall setting you up for a cleaner, more organized, stress-free tax experience moving forward. So that's our focus today. We've got a few key talking points that we'll go over, and we're going to start with why procrastination costs business owners real money. It actually has an impact on your business. And I'll start with throwing this one at Julie. What are your thoughts, Julie? Why should business owners not procrastinate, especially this time of year?
Yeah, sure. So first of all, just wanted to, give us a communal congratulations on this season 2. This is very exciting. And just thank you, Spencer, for facilitating these awesome conversations. So it's really great. That's such a great question. And it's really such a loaded question also, because procrastination, there's so many areas in accounting and in tax specifically where you can find yourself procrastinating. And some areas can be more detrimental than others. Sometimes you're even forced to kind of delay certain decisions in your business, even if you really want to be proactive. Sometimes you're kind of forced to just hang tight and hang low. So it's really a very loaded and nuanced question. I would say kind of the more common areas where people can find themselves kind of procrastinating and then can realize after the fact, that wasn't such a great choice. More specifically for business owners, when it comes to, for example, getting your financial statements ready for preparing a tax return or preparing an extension. So often we get clients that come to us with financials that are really half ready, a lot of things that need to be tweaked. And then the process just ends up getting delayed and delayed and delayed, when really having a good set of financials is so crucial right from the get-go. And if that was something that was done and prepared for consistently throughout the year, you wouldn't find yourself kind of in this space of having to clean up shop, many months later. So that's kind of from the business perspective. And then if we go over to the individual perspective, I guess you could say, procrastinating and maybe paying in estimates throughout the year can cost you in additional penalties at extension time. So, there are so many areas. It's such a loaded question that, you can find yourself procrastinating, I guess, which is why it's so important to have a tax advisor to be able to guide you on things that, in the scheme of things, what can you afford to procrastinate on? Like what won't be so costly versus you really should not procrastinate on this, because there's really a wide range and you can't get to everything all the time, all at once. But there are definitely a few key areas that procrastinating can really cost you. Those are, a few, just to name some.
Great point. And when I have conversation with clients, usually when we think of procrastinators, to your point, Julie, they typically don't have the cleanest books. They're not the most organized with their documents and their records. And I tell clients on calls, garbage in, garbage out. People have probably heard that phrase before.
Yeah.
We can't care about your taxes more than you care about your taxes. And so if you don't provide us with the right information, it's making everybody's job harder and possibly costing you on your tax return. And I think something that clients don't always think about or they don't view their CPA or tax professional in this way, is they just kind of think of taxes as like a filing activity. I'm
Mhm.
just getting them this box of receipts. They're going to type some numbers into a form. I sign it, and then poof, I'm done for the year, and I don't have to
Yeah.
worry about it anymore. But at Gelt, we really care about optimizing your taxes. You'll hear us say that a lot. And Adam, throwing this over to you, could you kind of give us the rundown of how clients should be thinking about tax filing versus tax optimization? What's the difference there?
Yeah, so I mean, filing, right, is simply reporting what's already been done, right? So, really just the compliance aspect of it, which is really, I think, how a lot of CPAs and a lot of individuals approach their taxes, right? So, and unfortunately, with the procrastination thing, a lot of strategies need to be executed by year end,
Yeah.
to actually have them into effect for the prior tax year. So, if you don't start thinking about your taxes until the new year, which I think is what a lot of people do, right? I mean, we have the holidays in December and so forth. Really, you're pretty much just a record keeper. Everything's already been completed and you're just filing the taxes and it is what it is. But optimization really is, a year-round process of actually identifying opportunities during the course of the year and executing those opportunities, right? So hopefully you're not leaving it up until year end. I mean, there always is that potential where, okay, we can do a fire drill, we can clean everything up at year end, but having regular meetings with your advisor throughout the course of the year to identify those opportunities. And there's current year opportunities where you can save taxes, right? Find some additional deductions, things like that. But there's also even long-term opportunities, right? So contributing to retirement plans. And I think a lot of times we think about, the benefit of the current year deduction from the retirement plan, but well, how about the tax deferrals, right? So that's the real opportunity, in my opinion, right? I have finance background as well. So you think about the tax-free deferral nature of your retirement plans. If those are going to be accruing for 20, 30, maybe 40 years, that's really the long-term benefit too. So, I mean, that's tax optimization, looking at it on a current year basis, making sure you're completing all your transactions on time and not behind the eight ball, when filing season comes. I'm thinking even longer term, even 20, 30 years out with your retirement portfolio, your investments, things like that. So,
Yeah.
yeah,
Yeah.
filing versus optimization.
That's great. And you've already mentioned a couple things that you have to do before year end, but there are some things that you can still get done before the tax deadline.
Yeah.
And with that being the focus of this episode, the countdown to tax day and what you could still do if you're focused on your taxes, maybe let's start with the bad news and then we'll end with the good news to leave people feeling happy. Maybe Adam, share a couple things that you can't do if you procrastinated until right now, February 19th, 2026, and then end with the good news. Give us a couple things that they could still accomplish before tax day.
Yeah. So by default, individuals certainly are cash basis taxpayers. And, most of your businesses also operate on a cash basis for accounting purposes. That's a little technical accounting type stuff. But what it basically means, it goes back to the thing where I said, all of your opportunities need to be executed in the current year by year end, the calendar year end deadline. So some things you can't do as a cash basis taxpayer, you no longer have the opportunity to accelerate your deductions or defer your revenue at year end if you're a business owner and you have opportunities to do things like that. There's certain deadlines if you're an S corp to establish a 401k. Technically, the 401k needs to be established by year end in order for you to even contribute. There may be potentially, an opportunity to contribute on the employee side up until your tax filing deadline, or employer side, I'm sorry, but the employee opportunity is for naught as well. And that's kind of particular to the S Corp organization. Your payroll needs to be run by year end. I have some new clients who are coming on board and, they didn't really, or well, they thought they paid themselves a reasonable salary, but they didn't actually run payroll at a W-2 in time by year end. So we're kind of, running a fire drill and patching that up by, issuing them a 1099 to kind of make up for it. And then moving forward, we'll do it correctly. Capital loss harvesting within your portfolio, that definitely has to be complete by December 31 of the year. Otherwise, that's a lost opportunity if you had any losses in your portfolio. charitable contributions, right? So you need to make them by year end, or you're not going to receive the benefit. If you miss it, then you're going to get maybe for the next year, and maybe in the following year, you're not even going to be itemizing. So it's going to be a completely lost opportunity. Roth conversions, right? So maybe last year you had a lower income year. We figured out, maybe it actually makes sense for you to convert your pre-tax IRA dollars to Roth. That has to be completed by year end. And if you don't do that, maybe your income is up the following year, and that's a lost opportunity. Yeah. As I said, most deductions and credits, anything that you're actually paying for, those need to be completed within the actual calendar year, or else the opportunity is just completely lost.
Yeah. Okay. And then what about some things that you could still do?
So, yes, there are some things that can be done by the filing deadline. You can make IRA contributions by your April 15th deadline. You could potentially make a SEP IRA contribution. In the case of a solo 401k, if you are an S Corp, you could still make your employer side contributions. Like I said, the employee opportunity was lost, but again, you would have had to have established that retirement plan by 12/31 of last year, or, it's just completely lost opportunity. If you're still filing as a Schedule C, disregarding entity, you could make your entire solo 401k contribution. So there's opportunities around the retirement plans, right?
Okay.
You can, if you haven't already topped up your HSA contributions, you can contribute into those plans, right? The employee health savings account plans. Some states allow 529 contributions, and that's on a state-by-state basis. So those are for, education savings on a tax-deferred basis. You can look at, it's really just an accounting thing, right? So like I said, would you be able to itemize? But really, it's just keeping track of what's already completed, so you can kind of, take into account all the deductions that you have, were there significant medical expenses? Did you have mortgage interest, significant charitables? But like I said, that's kind of already done and in the past. So,
yeah.
But you can look for those opportunities. Maybe, find some additional business deductions that you don't think you haven't thought of. Some of the opportunities that I see clients aren't necessarily top of mind are, home office deductions, deductions for use of a vehicle, or, health insurance. You can run that through the business and receive a deduction for that. So things like that.
Okay. So there is still some good news. And if you file an extension, do the moves that you can still make, if you file an extension, do those moves have to be done by April 15th, or can they be done before October 15th?
It depends. So most of the retirement contributions, the extended deadline would apply. So you could make contributions up until the October 15th deadline, but yeah, it's kind of on a case-by-case basis. It gets a little bit tricky on which ones they allow, with an extension.
Okay. Got it. All right, Julie, throwing back to you, I want to talk about extensions. So I brought up extension in that last question to Adam.
Yeah.
And this time of year, we might have some procrastinators that are still looking to sign up. And Gelt, as well as most high-quality CPA firms, we would probably argue, if you're signing up this late into the season, you're probably going to be put on an extension, or most firms are getting really close to that timing of putting you on an extension, especially if you're a business owner and we're looking at a March 15th tax deadline.
Yep.
Sometimes when I bring that up in calls, I get a little bit of a panicked look or a concerned look, like we are asking them to do something incorrect, illegal, gonna get them in trouble. When you think of an extension, how do you communicate it to clients? Is it a strategic tool that they should be using, or is it truly a red flag that they should be fearing?
Yeah, no, it's a great point. And I guess every year it almost surprises me when I hear that kind of feedback about an extension, because here's a tool that the IRS is giving us, right? It's a form, an IRS form that they are giving to the taxpayer to say, hey, if you don't have your stuff ready, go ahead and file an extension. Now, it doesn't extend your time to pay, so you still have to pay your tax, but it extends your time to file. So it always surprises me every year when I hear that kind of feedback, because we do get it quite often. And, I can certainly understand perhaps where it's coming from, right? Especially for those that are not procrastinators and they're used to wanting to get things done. The thought of having to, choosing to push something off could feel a little bit unsettling. And, is the IRS going to go after them and going to question it? So the long story short to that is absolutely not. Again, like I said, an extension is a tool, a great tool that the IRS gives to any taxpayer that wants to, the opportunity to extend the time of filing by 6 months. So for a business owner, an S corporate partnership from March 15th to September 15th, and then for individuals and C corps from April 15th through October 15th. Again, this doesn't extend the time to pay. So what the extension means is that you still need to come up with a rough idea of what you're going to owe. So it's important that you have a general idea of, what your business income is going to look like. At this point, you probably have most of your tax documents, your brokerage statements, your W-2s, most of the heavy hitter items to be able to compile together to be able to calculate a rough idea of how much tax you're going to owe. But then choosing to extend it and a couple of months even is really just an opportunity sometimes for your CPA, if you join a new CPA, to really take the time to get to know you, get to know your books, get to know your business. So often, we get clients that feel that panic of, I don't want to file an extension. And then we explain to them it's almost in your best interest, right? There's so much going on. You have such new complexities. We really want to make sure that we're optimizing the most we can for you. And if we're just going to rush into a tax return, it's very possible we may miss something in the name of filing early.
Sure.
So unless there's a specific reason, sometimes we get clients that come to us. They need to file tax return in order to get a mortgage. There are real reasons sometimes to file early, and we totally understand that, and we'll support that, and we'll do our best to get that return out. But for new clients, especially, even if someone is joining us, not necessarily this late, could be they're joining us early January, end of December. If they are presenting more complexities in their return, we really try and guide clients into this first year. Let's put you on an extension. Now, it doesn't mean we need to wait until September or October to file. We could file you in May or June, but let's just give us some breathing room so that we can really get to know you and get to know your situation and make sure we're really capturing everything that we can. But, for all those out there that feel like there's anything wrong with an extension, you may never have filed one before. I get that all the time. I've never filed an extension before. There's truly nothing wrong with it. Again, it's a tool, a legal tool that the IRS gives us to be able to utilize it when needed. So, I definitely want to take away any of that unnecessary fear for those people that may think that.
Yeah, that's great. And I also like to share that it doesn't mean we're going to wait until September 15th or October 15th, but
Sure.
it at least gives us the margin to get this done later in the spring, early in the summer. And you probably don't want to start a new CPA relationship with less than 2 months to get something done and just rush through it. Sometimes things change and then you have to file an amendment and you've got to pay to file the amendment, and you're just kind of reopening the tax season for you once again. You might as well have just extended and waited.
And that's a really good point about amendments. In the world of what's considered risky, if you're comparing an extension to an amendment, it's a completely different world. An extension is something that, again, is completely accepted, completely normal. And an amendment, not that it's not accepted and not normal, but if we're putting a standard on or a rating, I should say, on what's riskier, I would certainly put an amendment much higher up there than an extension, right? An amendment is already, flagging to the IRS like, what changed? What happened? Why didn't you get this right the first time? So, if there's any reason that we could risk having to amend something by getting it out early, we want to try and avoid amendments at all costs. It's generally not the best approach. So
Yep.
it's a good point.
Yep. I've had those conversations as well where I tell them, if you are signaling to the IRS that there is all of a sudden this new special reason that you need to fix a return that you've already filed, don't you think you're kind of tipping them off as well? Like, Spencer felt it was worthwhile to file this amendment. I wonder if we should also look into this special new reason that Spencer thinks it's worth filing an amendment. So be patient, even if it's a little bit hard. And if there's probably a legitimate reason why people really want to file on time, it's if you're expecting a big refund, I would say, because you don't want to loan the government a lot of money for any more time than you already have. But even then, like, don't file end of January, early February. Maybe wait to make sure you get all your forms and you have everything put together.
Yeah.
And another good point that I want to drill down a little bit further, because this is important. It's an extension to file, not an extension to pay. So if you have not paid, you could risk penalty and interest. What is that payment amount that clients need to be aware of? Is it the safe harbor that they hear about throughout the year, or is this like exactly to the dollar you've got to figure out what you're going to owe?
Yeah, sure. Did you want me to take that one? Did you want
Either one of you.
Okay, Adam, did you want to take that one?
I believe you need to pay a 90% of tax to avoid the late payment penalty. Is that correct, Julie? But interest.
So that's for estimate. That's for estimates. But
I
for
know
the yeah, so that's for estimates. So if we're talking about the extension, right? So estimates, we won't go into that right now because that's, there's different ways to calculate an estimate. But for the extension, that is the tricky part about the extension, is that you kind of got to get it as close as you can.
Yeah.
The IRS is expecting you to really pay in pretty much, exactly or pretty close to what you're expecting to owe, which could be hard because sometimes things may change. If your financials are not fully finalized yet, then you may see you'll have additional deductions that you weren't expecting, or you may not have as many deductions, and therefore you underestimated how much income you were going to have. So getting that extension calc is really important, because what could end up happening if you underestimate how much tax you're going to owe, then when you file your tax return, any difference in tax that you owed, there's going to be interest and penalties on top of that, which is not fun and really, not something that we want to happen to our clients. So if you are going to go on extension, it's important that you have as much of your information available as possible so that your CPA can really try and get it right, so that we're avoiding any possible penalties, even in the name of sometimes being a little bit more conservative for the extension, so that if you end up overpaying, you'll get a refund and at least you won't owe any penalties. So it's definitely important to try and get it as close as possible.
Yeah. And in a previous episode with Rachel, she even shared that sometimes Gelt will strategically advise a client, if we want to be on the conservative side, maybe let's take your first quarterly estimated payment. And for business owners, that's usually a requirement that you're doing anyways. So instead of paying into the Q1 estimate, let's pay into your prior year tax return. So 2025 in this example, because if we're on extension and by the time we get around to filing it, let's say August, for example, if we find out, well, we were too conservative, you did not have to pay that in, you could either take the refund if you don't need to make quarterly estimated payments, but likely you would. And so you could just apply that refund to your Q1 estimated payment. And it's not really a cash flow bummer to you because theoretically you were going to pay that cash anyways as a Q estimate.
Yeah, that's always a nice little trick. We'll bump up our client's extension and say it's kind of like a cushion, right? If you need it for 25, it's there. If you need it for 26, it's there, and you have the flexibility. So that's always a nice little hack that we use here as well.
Yeah, I thought that was really cool. Adam, did you have anything you wanted to add to that?
As strictly a tax professional, yes, exactly as you said, I would recommend overpaying a little bit, right? So you don't have that risk. But then, as a person, right, I understand nobody wants to pay an extra tax. I get it. But that was a really great point that you brought up, that you can apply your overpayment to the following year, and then it applies to your first quarter estimated payment. So kind of a win-win from that perspective, I guess.
Yeah,
Totally.
for sure. And Adam, we'll keep it with you. So we've, just kind of at the end of that topic there, we brushed on making payments, cash flow, making sure that you're not surprised, I guess, come tax day. Any advice for the listeners on smart ways to plan for these payments so that you're not in this cash flow crunch come March 15th, April 15th?
Well, again, yeah, I think it comes down to proactive planning, right? So, working on it throughout the course of the year and doing, maybe even quarterly projections, right? So reviewing the need for estimated payments on a quarterly basis. So again, like you said, it doesn't catch you off guard at the end of the year and you potentially have, all of these estimated tax penalties and interest accrued. So again, it's really just a matter of being extremely proactive. Of course, there's the boring part about, just setting aside funds, right? I mean, nobody really wants to do that, but that's the boring part of my job and the conversations I don't enjoy having with clients is, hey, you have this tax liability due, or hey, you need to do this on a quarterly basis, right? The exciting stuff is finding ways to reduce that liability, but at the end of the day, there probably is going to be some kind of a liability, right? Unless we can, completely eliminate your tax liability, which, usually isn't the case. So, setting aside funds, budgeting for that on a quarterly basis, putting it in an interest-bearing account, things like that, making sure you're not throwing money out the window by hitting your estimated payments. I have clients who say, well, no, I don't really even want to make estimated payments. I think I can do better in the market. Okay, I'm on the tax side of things. If that's the way you feel, fine. But, as a conservative tax professional, I would recommend making your estimated payments, right? I mean, otherwise, it's almost like credit card debt or something to the U.S. government. So that's kind of the way I view it. But I did have a unique example. So a newer client, she just came on board. She's going to have a pretty big liability this April. I think she has the cash, but we were thinking about maybe some creative ways of, generating funds. She wants to keep reinvesting in the business, wants to maintain her cash reserve on the personal side. But she recently left a W-2 employer where she had significant equity compensation. So she's established this portfolio of stocks, in her former corporate employer. She has a very large position in the particular company. And number one, she told me, well, it's pretty volatile, at least I gathered from the conversation. So it's been up and down, literally from like $400 to $200, and she's getting close to retirement. So, financial advisor side of me, oh man, we need to diversify. We need to get you, more stable. But it presented another opportunity too. It sounded like there are some winners and losers in her portfolio. I'm like, well, no, I think number one, we can help you diversify, which is great. And then maybe we can also generate some funds for your tax liability, right? By offsetting, gains with losses. So net from a tax perspective, it would be equal. We'll get you some cash for your tax liability for 2025 and maybe even moving forward. And then maybe you can even get yourself diversified as you are getting closer to retirement. So, I think that was a pretty good conversation that we had. So,
yeah.
Adam is just for all those. Adam's coming from a wealth management background. So I love his spin on things, always has that wealth management kind of viewpoint. So that it's definitely a great perspective to have when it comes to tax. So I love that.
That's awesome. And thinking creatively to try to help your client out. That's what Gelt's all about. So you're living it, Adam. Appreciate
holistic.
That. Yes.
It's all about being very holistic.
Fine example. And I hear you on the skipping estimated payments, thinking that you can, kind of make arbitrage the estimated payment money that you're going to send in. I also find it to be a very confident position to take that you're going to beat, because I think it's 8% is the
7 or 8% is the IRS interest rate, and what's cash paying now? It's down now. It's like 3 or 4%.
Yeah,
so you can't make that argument anymore. But you're saying you're going to do, better in the market. I do that, but the market is risky. So
yeah, I have some clients that still make that argument, and you know what? Good for them. Like that's great. I support them in that. And they come with a lot of confidence. It's true. You have to be confident to make that kind of position. But hey, if that's what they want to do, all the power to you.
Yeah.
The market's done so well for so long. I mean, people forget. I mean, it's been, maybe with the exception of COVID, up and up, since the real estate crisis in 2008, 2009. So It's a personal decision.
Yeah. Julia, I'm curious to get your opinion. You have some clients that do it and they're very confident. If someone just asked you, like, Julie, what should I do? What would be your recommendation?
You're talking about in terms of whether to pay estimates or not.
Yes. Mm-hmm.
Yeah. So, I would agree with Adam, right? We're the professionals. We're telling you what you should do. What does the IRS ask from you? We're going to give you those numbers. We're going to tell you what you need to do in order to avoid your interest and penalties. At the end of the day, you can choose to do what you want to do with it, right? So as a CPA tax professional, I wouldn't obviously tell anyone. That's not the place that I'm coming from. But again, we have clients that are very well versed in the market, and they're going to choose to make that choice, and that's up to them. But I would never advise someone to do that simply because that's not my role, that's not my expertise. I'm coming from the tax space, so we really want to set you up for success. Make sure that you're compliant, with whatever the IRS expects of you, and then at the end of the day, you're going to choose to do what you want to do, right? And it's not only when it comes to estimates. It really comes with regards to everything, every strategy that we advise our clients on, right? Ultimately, at the end of the day, it's a choice, right? It's a choice that has to make sense in your life. It's a choice that has to, I'm getting a little philosophical here, but there's a lot of strategies that require, outlays of cash right from the get-go. If you want to go into the real estate space, I can get a question of, should I buy a property and perform a cost segregation study on it? And it's such a loaded question because you could, right? But does that make sense for you? Is that where you're at in your life right now? There's so many different factors, right? So, I'm going to tell you what your options are. I'm going to tell you what I think makes sense for you. I'm going to tell you what are some opportunities for you, but ultimately it really has to work for you and it has to make sense for you, right? So you can apply that kind of argument to anything. There are tons of strategies and tons of ways to approach your taxes, but at the end of the day, it has to be very individual and it has to really work with you, and that's something that we really pride ourselves on here at Gelt, that we really try and make our strategies and our recommendations very relevant and, client specific, because no person is the same and no tax situation is the same. So it's really a much bigger philosophy that can apply just to so many different areas of tax.
Yeah, absolutely. And I do think that that's what makes Gelt special as an advisor for our clients. And I like to tell people on calls, we are trying to help you reduce your tax bill legally in accordance with your goals. And I throw that last sentence in there because just like you brought up, Julie, not every strategy is going to be a fit for every client. We think that it's our job to educate you on the options that are available to you. So like you said, you could go buy real estate and try to use it in a tax advantaged way, but is that really the best fit for your lifestyle? And sometimes, as a joke, I like to use myself as an example on the calls. I'm a client of Gelt. I do have rental properties long term, so I can't do the short term rental loophole. I have to go qualify as a real estate professional. Doesn't work for me because I'm a W-2 employee here at Gelt. But my wife now no longer works. She stays home with our daughter. And so Gelt very proactively was like, hey, maybe Steph, my wife, would like to start managing the rental properties and tracking her time and qualifying for real estate professional status.
Oh, I love that. That's
Yeah.
great. I didn't realize that. That's awesome.
Yeah, so did I. I thought it was great of Gelt, but to your point, I didn't end up pursuing it. And the reason why is because I think my wife would kill me if I had her take care of the 11th-month-old daughter and handle leaking toilet text messages.
Or fixing the plumbing.
Yeah, exactly. So would it have saved us money on our taxes? Sure, it would have, but there's more to life than just saving money on your taxes. So it is very individual to everybody's situation. But
that's a great example. I love that.
Yeah. And a little bit of a tangent off of our topic for today, but I think it was good. And so to bring it back around, and we'll wrap up this episode, Julie, I'll ask you to wrap us up. Thinking about tax day, the deadline's coming up. We're in the countdown to the tax deadline. Thinking about resetting yourself for the future. You've procrastinated. It's been painful. You don't want to do it that way anymore.
Yeah.
What's some advice that you would give a client in terms of documentation, systems, habits that you should form going into 2026 that's going to make your tax life easier and possibly even more optimized?
Yeah, sure. So, we had spoken a little bit about this at the beginning of this call, but you'd made that point, garbage in, garbage out. When we get clients that come to us and they don't have the proper framework for preparing a tax return, maybe they don't have a payroll provider, maybe they don't have a platform that, can help with bookkeeping like QuickBooks or Kick or any of these platforms that are out there. We really can't do our job the best that we can. I tell clients that our strategies are only as good as the information that you give us. So my first recommendation to anybody that's considering, any tax professional, or you're really looking to kind of ramp up your, whether it's your business or your personal financials or whatever your goals may be, it's so imperative that you have the right foundation. And that means using a platform like QuickBooks when it comes to keeping your books organized. It's easy if you have, maybe 50 to 100 transactions a year and it's kind of a low activity. But once you really start ramping up your business, especially in, let's say the real estate space, when you have so many expenses, it's so imperative that that information is organized, not only for your accountant, but for you as well. You want to be able to look at your stuff and say, is this property profitable? What did I earn on this property? What could I do better with this rental that I have? It just gives you visibility to be able to make much smarter and better choices. So now's really the time to, kind of visit what are those resources out there that can really help you. So obviously in addition to having a tax advisor, a really competent tax advisor, you want to make sure that you have a good payroll provider. We recommend our clients using systems such like Gusto that really take care of your quarterly and monthly annual filings, payroll filings. That's so important if you're a business owner to make sure your payroll's done correctly. Just setting yourself up for success, that there are so many tools and resources out there that are really there to make your life easier. So I couldn't stress that more. It'll really set the ball rolling, in a really positive way and just allow them to do what you want to do best, which is operate your business, be a business owner.
Mm-hmm.
So, I couldn't stress that more.
Yeah, that's great. Well, thank you to everybody listening. If we're going to summarize this, let's try not to rush come tax season. Let's have proper processes, record keeping, some regular check-ins with your CPA throughout the year. We want things to be clean. We don't want to treat taxes like a once a year event, and definitely don't think about just filing instead of also optimizing. You don't want to just hand your CPA that shoebox full of receipts and just think, well, that's all right. It's all taken care of. I don't need to provide any additional input. It's a team sport helping you with your taxes. So if you're a business owner out there, just make sure between now and March 15th, April 15th, possibly if we put you on extension or if you go on extension with your CPA, you have some extra time. But this is your time to be intentional about 2025, your last opportunity to be intentional about 2025, but your first opportunity to set things correctly into 2026 and the future. So thank you, Julie. Thank you, Adam. Always great having you on, Julie. Adam, great to have you on for the first time. Looking forward to future episodes with you. And thanks everyone for listening. Subscribe, comment, like, share it with your friends and family. And we look forward to the next episode of Tax Talk Unfiltered. Thanks, everybody.
Thanks, Spencer. Take care.